Hello, everyone, and welcome to Calling All Real Estate Investors for our live event today with Caeli Ridge from Ridge Lending Group. You can reach us at info@ridgelendinggroup.com, or you can call us at 855-747-4343. That's 855-74-RIDGE. And during today's live call, if you have any questions throughout, please just drop those questions into the meeting chat. And then as they come up, and then we will answer them as soon as possible. So today, Caeli is going to be talking about creative financing strategies for non-owner occupied portfolios. So I'll go ahead and hand the mic over to Caeli Ridge now.
Hey guys, Happy New Year, everybody. Happy freaking New Year. You know, it's hard to believe for me that it's actually 2024. And I was just thinking about this yesterday. My husband and I were talking that it's 2024. And given where we were, let's say 2019, at the end of 2019, and then early 2020, okay, and then everything that happened between then and now, I feel like I've kind of been in this dream. And then when I look back, it's almost as if none of that even happened. Doesn't it feel that way to some people? I've been asking this question, and a lot of people have been saying, yeah, it's like you were in this weird daze, and now, you know, the smoke is cleared and 2024 looks bright. I'm feeling very optimistic for whatever reasons. Maybe, you know, it's placebo. I don't know, but I'm going to take it. Anyway, thank you guys for being here. Happy New Year, as I said. I want to start and just get this out of the way because I know that everybody wants to talk about interest rates. If I could see you all, I'd say give me a show of hands, and I know everybody's hand is going to go up. So I'm going to beat you to the chase. Let's talk about where interest rates are. If you have been watching the news, and even if you haven't been watching the news, chances are this comes up on your feed, and you have heard that interest rates are on the way down. Woohoo! Excellent news. Now, it may not necessarily be that the rate is going to appear much lower than what we've seen, but the points associated with the interest rates that we have been securing and quoting and locking for the last year especially are probably what you're going to see the biggest difference on. Something called premium pricing appears to be back. So the points that you would have to pay to get in the door for a non-owner occupied and the interest rate that you'd be locking are going to be lower as a result. I'm not going to go into why. We've talked about that several times before on these live with Caeli's. So I won't get into that now, but I will give you guys an idea of where rates are today based on the following variables, because remember, the characteristics of the loan itself are going to exclusively dictate where your interest rate's going to lie. So the variables that I'm using to give you today's posted rate are as follows. This would be a purchase transaction. A refinance transaction is going to have a slightly different interest rate. A cash out refi, one slightly different than a rate and term refi. Right? Those are the different variables we're talking about. So this is going to be a purchase. I've got my notes here. I looked it up before we logged on here. It'll be a single family residence. My loan amount is $150,000. This is a 75% loan to value, or LTV, assuming a 760 or better credit score, 40% debt to income ratio or less on a 30-year fixed mortgage. Drum roll. Carly, do you have a drum back there somewhere? Drum roll. I'm kidding. I'm teasing. I'm teasing. The interest rate you would lock today would be 6.875, and that would be at a 2.5 in total points. 2.5 in total points to get 6.875 on a 30-year fixed single family purchase, 150,000 loan size, 75% LTV, 760 score, with 40% or less DTI. That's where we're falling today. And I do expect my crystal ball does seem to overwhelmingly tell me that we should see some additional improvement there in the coming weeks. Now, you've also heard me say that interest rates come down a lot slower than they go up. So I think that we sort of saw an initial fall. Today, they seem to be up from where they were last week, but that may just be coming off of the long holiday weekend. We'll see what happens tomorrow when secondary opens up. But anyway, it's great news, okay? 6.875 on the variables that I listed before. All right, so let's get into this. Carly, you got something?
Yeah, before we dive in, we do have a question. Is a cash out refi always more expensive? And if so, why?
Yeah. Yes, it is. It's going to be let's just go over the three different types real quickly. So if you've got a purchase and you've got a rate and term refinance and a cash out refi, let me define rate and term. A rate and term just means we're simply replacing an existing loan with a new loan. So whatever your existing balance is plus closing costs is what the new loan amount is. You're not getting any cash in hand. That's going to be a rate and term refinance. A cash out refinance is when you're actually going to get cash in hand. And yes, that's going to be of those three distinctions, purchase rate and term cash out. The cash out is going to be on the higher end of the interest rate spectrum. And the reason for that is it's going to be higher risk for the investor or the lender that ends up picking this up. If you're leveraging and pulling cash out against an investment property, let's say values were to fall, or it could be a number of different reasons that the property itself could ultimately default. But if you're actually going to get cash, borrowed funds are non-taxable, it's going to look at as a higher risk than if you were just purchasing the property and putting 25% down. So another example, let me give you a for real example. Let's say that, and it's got to be the same across the board. Okay, so let's say that you purchased it for $100,000 and 5 years have passed or 10 years have passed or whatever, and you haven't refinanced for whatever reasons that you have. You've got all this equity built up now, and you're just going to pull that big chunk of cash out of it, that property. So from a risk layering perspective, taking that property from whatever its initial use was and making it a cash out refinance investment property is going to be looked at as a highest risk level. And that's where the LLPA is going to come in, and it's going to be a higher loan level price adjustment than it would be if it was just a simple rate and term. And then the purchase, as I said initially, isn't going to hold either one of the refinance distinctions. Hopefully that made sense. I kind of talked in a circle there, but cash out is going to be a higher interest rate, and those are some of the reasons why. Anything else real quick before I get into our topic, Carly? Okay, so we're talking about creative financing, you guys. And I took some notes here. I'm going to read off of them. First of all, let's talk about, creative financing can mean different things to different people. So let me start by just defining for myself how I will interpret creative financing. My definition is going to be any combination of traditional or non-traditional means of leverage or financing to get you or to get us across the finish line. Okay, it can be a combination of several different things. And then before we get into the different variables for creative financing, let's also take a minute and identify the why. What would be the need for the creative financing? Because the answers are going to vary based on why you're looking to, or what the need for the financing is. Typically, it's going to be, 2 or 3 different things or some combination of the following things. We've got maybe lack of funds or maybe lack of seasoned funds for down payment or reserves. Maybe we've got credit issues, damaged credit, no credit, poor credit scores. Perhaps as an example, what if your credit score fell below the minimum required to qualify? 720 is a benchmark that a lot of you are familiar with. What if you had something called rapid acquisition, where you purchased a bunch of properties in a small window of time, and as a result, it temporarily dropped your score below the minimum required 720? That could be, but you had to close on the next purchase or you're going to lose 10 grand in earnest money, right? That might be a scenario where creative financing would be necessary. You otherwise have good credit, but this might be a temporary bridge that you're needing to secure. So it could be credit issue related. Maybe it's debt to income ratio. And typically speaking, I find that the need for creative financing generally falls within, more often than not, the DTI, debt to income ratio space. Maybe you're self-employed like me and you don't show a lot of income, perhaps, right? You've chosen to maximize the tax deduction. And as a result, you're just not going to show the amount of income that you need to offset an individual debt to income ratio. Maybe you just changed jobs and we can't use that income for another 6 months or another 12 months or whatever it may be. Maybe your monthly liabilities are too high. You've co-signed for some kids or family members that are not making the payment or cannot show that they've been making the payment, so you're on the hook for them. It could be any one of those variables that could create the need for creative financing. And there's many, many more, okay? And I'm going to get into some of those as we start talking about the different layers of creative financing. So let's start with purchase, okay, as it relates to creative financing, as it relates to a purchase transaction. These are in no particular order, you guys, and I might ping back and forth between them. But the first would be seller financing. That's very creative, right? You have really no means. Let's just say that you're in a situation where you really are having a hard time qualifying either yourself or the property, right? Maybe the property is the issue where the creative financing is needed, right? The property cannot pass inspection for X, Y, or Z reason, and that's why we need the creative financing. Seller financing might be an amazing way in which you can secure this investment property. Now, if you have a property in mind, it's easy enough to go ahead and put that out there for the seller. If you're using a turnkey, that's probably not likely. But if you're out there, beating the pavement for yourselves and your own purposes, and you're not using an agent, or maybe even if you are using an agent, and you have this property that you want to purchase, but there's issues with X, Y, or Z, all the things and maybe more that we already discussed, we can ask the seller if he or she might be willing to provide seller financing for a year or 2 years or whatever, under the precipice that you will refinance at some point. Let's say you've bought yourself 2 years. The seller is going to go ahead and fund. You've got a little bit of money down. You can throw a couple $1,000 at it, and the seller will give you, or you will secure. They're going to kind of be the bank. Okay. They're going to say that they're going to fund this, or they're going to provide financing at 6% interest rate on a 30-year or even an interest-only basis. And after 24 months, there's a balloon feature on it. Okay, on this note that you've recorded with the seller. And after that amount of time, you have to refinance this loan at the predetermined purchase price. Okay, whatever the market value is down the road isn't going to be, probably not part of the conversation, but you're going to refinance and pay the seller off at that point. That might give you all the time in the world to repair credit, or to save for the extra down, or debt to income ratio, or your new job has now been seasoned and you can show the amount of income that you need to qualify, all of those things. So seller financing is a pretty popular one. It's probably the hardest in which to secure, right? There's not going to be a lot of sellers out there that are going to say, sure, no problem, I'll go ahead and finance this for you for 2 years or 5 years, or whatever it is. Chances are that that'll be far and few between. For those that are interested in how to find this from a lending, or excuse me, an investor perspective, here are some tricks that you could impose. You can do title searches. You can get with a title company, title or escrow company, and do title searches that will provide lots and lots of data. Really, it's customizable to whatever information you want about the property and the demographic of the property, the history of the mortgage on the home. But what you might be looking for is a first payment default, which is public record. You can get this from a preliminary title report. And if you were to go to any escrow or title company, Fidelity, WFG, Chicago Title, right, all of the big names, and say that I want a title report. It used to be called a farm. I don't know what they call it now. But you can give them a zip code for the area in which you're looking to acquire properties from, and you can get the data that you want. It has to have this bit of information, this bit, this bit, this bit, right? You can kind of customize what you want on there, but specifically, it might be to your advantage to pull those that would be in distress, right? The ones that have that public record first payment default, or are in default, or maybe even in foreclosure. The foreclosure process in most states, it can be lengthy. So there's probably a lot of time between maybe missing a mortgage payment and when that property actually will fall on the courthouse steps for the foreclosure process. So you may be able to get that information, get in touch with the seller and say, hey, listen, necessity is the mother of all invention. You're having some issues. I would buy this property. You can get some sell. You might have to bring it current, right? There may be some different things that you have to do, but that might be one way that you can get into some creative financing if you've got some your own issues over here that are precluding or prohibiting you from getting traditional financing. So that would be one. And if you guys have questions about any of this along the way, please jot them down. We'll get to them toward the end, okay? The other thing would be a JV, a joint venture. So I see this one a lot, and I would say, let's start by let me preface by saying, for me personally, this can be tricky, okay? To get into a joint venture, even with your best friend or a family member, carries, I think, extra liability. So make sure that everything, my advice to you would be, is that if you're going to get into a situation where it is a joint venture, make sure everything that you can possibly imagine has been written out for both parties. There's no question, as clear as crystal, about the equity split, the cash flow split, the tax advantage split, the appreciation. All of those things need to be identified. And you may want to, if this is the first time you've considered doing something like this, it's not always just a simple 50-50. Let's just say you've got a JV, a joint venture with one other person. It's not as easy as to say, everything is split 50-50. It's really going to depend on who of the two, if there are only two, is taking the higher risk. If the one taking the higher risk, I'll give you an example in a second, that one should probably get more of the X or Y, right? That's going to be for you guys to judge or determine. But I wouldn't just get into a JV and say for sure it just would be 50-50. Under a joint venture, let's say that you have lacking credit. You don't have any credit. You've got poor credit, but you've got money. Okay. You've got the money, but you don't have the credit. You want to get into a JV with somebody that doesn't have the money. They've got great credit, but they want to get into real estate, right? You guys can fill in the blanks there. It might be a opportune way in which you can propel yourself into your first, your second, or your third, depending on what your scenarios are. Where do you find people like this? They could be friends, they could be family. There's all kinds of real estate investor chat rooms and blogs. I mean, that's a little sketchy, I think. I don't know how secure that would be or how I feel about that. But if you have groups that you belong to for any length of time and there is a level of integrity and trust within that group, it may be a good place to look for a JV. That would be another way of creative financing. You've got private loans or bridge money loans. So those are going to be much easier to secure. You're going to pay through the nose for them, but if you have to get something done for whatever your reasons are, those would be a creative way in which to get your foot in the door. You'll buy yourself 6 months or 12 months to then refinance into more permanent financing or sell it, right? Make sure that in any situation, whether we're talking about short-term, long-term, fix and flip, fix and hold, whatever it is, you guys have your backup plan. I know you probably already know that, but it doesn't hurt to reiterate that point. Have plan B and C just in case something about plan A doesn't go well. I see it every single day, even for seasoned investors that know what they're doing, but didn't have a backup plan for their short-term rental, and now they need one. And it may not be a viable one. So they could put themselves in harm's way, and it can be significant. Again, I see it regularly. What else do we have here? So we're talking about purchase, right? Creative financing for purchase. Let's say that your scenario is that you don't have the down payment, okay? If you were to plan ahead, you could use a line of credit, an unsecured line of credit. A secured line of credit is source and season funds. Or let's say that if you had a secured line of credit, it's tapped out and you don't have any more equity to access. So maybe you're going to look at an unsecured line of credit. Okay, this just means it's based on you, maybe some other asset that's not real estate that you could secure it against, but for our purposes, it wouldn't count. But if you can get your hands on an unsecured line of credit for a down payment and or reserves, that would be fantastic. However, remember, you have to plan ahead. Those have to be sourced and seasoned funds. So if you did find yourself with unsecured line of credit, 50 grand, 20 grand, whatever the amount is, you're going to have to pull it out, pull all the cash out off the line, drop it into a checking or savings of your own, and let it sit there for a full 60 days to where we no longer see the deposit. Because if I see that large deposit, I'm going to question it. So I don't want to see the deposit. I want 2 months worth of bank statements that just show the balance. Now those funds are sourced and seasoned. Now in that scenario, you're going to have to probably pay interest, right? Interest payments on that, unless you can find an unsecured line of credit that has a teaser, zero interest for 6 or 12 or 18 months, whatever. That would be amazing if you can do that. But if it's for a purchase, a down payment on a purchase, different conversation with a line of credit if we're talking about a refinance for the BRRRR strategy, for example, and I'll get to that shortly. But if it's for a purchase and your down payment, the rules say that if you can get the financing, otherwise you just don't have that down payment, they cannot be borrowed funds. Gift or borrowed funds are not allowed on non-owner occupied. So if you can get your hands on an unsecured line of credit, you're going to want to do that. Draw the money down, stick it into an account, let it sit there for a full 60 days. We do not want to see that deposit or you won't be able to use it. Then you've got your source and season funds. Another thing that we can look at for creative financing is house hacking. And I'm seeing a lot more of this lately, and I think it's amazing. I absolutely love it. Ideally, you're probably doing it on a 2 to 4 unit. House hacking on a single family has some limitations. But for those of you that are looking to purchase their first primary residence, or maybe move out of their existing and turn that one into a rental, you can get very high leverage on an owner occupied. Fannie Freddie now have 95% on a 2 to 4 unit. This is coming up. Why don't I just spell this really quick for anybody that saw that headline that 2 to 4 units are now available for Fannie Freddie loans. That is only for owner occupied, gang. That does not apply to an investment property. You cannot get a Fannie Freddie duplex, triplex, fourplex at 5% down as an investment. You'd have to buy it as a primary residence, but that goes into what I'm talking about here. So for house hacking, you can creatively purchase a single family, but ideally, I think the 2 to 4 works better. 2 to 4 unit property, live in one of the units for a year or whatever it ends up being, and then have the other units as rentals. And then you move on or move up to the next, right? You keep that property as an investment property. Maybe it's appreciated. Maybe you do a cash out refinance after a year or two, pull the equity out, and then you've kind of jump started your investing process by house hacking. I love that. I love the new investors that get into that, or even seasoned investors that get into that. I think it's a very smart way to start real estate investing. Let's see. What do I have here? Alternative financing. I'll just take a minute because I think most of you, we've talked about it so many times, but I'll just touch on it. Creative financing technically should include the debt service coverage ratios for those that can't qualify conventionally or full doc. We have the products that allow us to go to 0.75 on a debt service ratio. So if your rents were 750 and your mortgage payment was 1,000, that would equate to a 0.75 debt service coverage ratio. That would be eligible for financing. Okay, the lower the DSCR, the higher the rate, but it's available. The other two that we don't spend a ton of time talking about that I'll just touch on really quickly as more creative financing. Let's say that you can't show tax returns, for whatever reason. We can look at bank statements or 1099 statements. Okay, if you're a contract employee and your tax returns you write off too much. We can take 12 or 24 months of bank statements. We're going to add up the sum of all the deposits that you've got or that you've received, and then we're going to divide that by the number of months in bank statements that you've supplied. So if it's 12, we'll divide by 12. If it's 24, we'll divide by 24. That number is the amount of income that we're going to give you to offset your monthly liabilities. Okay, so if your tax return, you've got just too many deductions on there, but you are a strong income earner, bank statements might be a viable way to do that. Asset depletion is another one that a lot of people get confused about or unaware of. If you have substantial assets, okay, depending on the asset type, we can use those funds and there's two ways we can use them. The first would be a regular distribution income. So let's just say you had $1 million in a stock exchange. If you were to elect to take a regular distribution, you'd actually have to take the distribution for at least while we're doing the loan, the amount in which we have already identified for you that says this is how much money a month you need to show in order to qualify you. If you had enough in the asset so that there's at least 36 months of continuance from the monthly income that we have assigned to you for qualification purposes, that's actually a Fannie Freddie loan. Right? That actually qualifies conventionally. So let me give you an example. Let's say that you need $10,000 a month to qualify. Okay. As long as the asset account has 360,000, right? 36 months worth of accessible asset, then that's really a full doc Fannie Freddie loan. You'd actually have to take the distribution. We'd have to see we'd have to see the form. There's a form that you fill out with your asset. Who's your guy? You know what I'm talking about. You fill out the form, you take the 10,000, we'll see the 10,000 coming in. What you do with it after you have it is entirely up to you. You can put it right back if you wanted to, but we actually have to see that paper trail. And then once the loan was closed, you can remove the distinction of receiving that regular distribution of income. Okay, that might be another creative way that you guys actually now have access. You just didn't realize it was a thing. Obviously for down payment, gang, you can look to leverage a second lien on your other rental properties or even your owner occupied if you haven't considered doing that. as a means of harvesting equity for down payments. Second lien is an option. You know that we have those too. Any questions about that, put them in the chat. We can talk about it again. And then finally on this list, cross-collateralization. So this is a means of taking multiple properties, putting them into one blanket commercial loan. A lot of you are familiar with at least the concept of this, but what most people don't know is that it can be used, it can be used for both purchase and refinance at the same time. So let's say that you've got this package of properties that look great and you want to buy them, but you don't have any cash, any liquid cash. It's tied up in these rental properties over here. We could actually refinance, cash out, let's say 2 of your rentals that are going to yield enough in the cash for the down payment on this, 5 bundle of properties over here. All 7, 2 refis, 5 purchases, all 7 properties would be in that cross-collateralized loan. So that might be another way creatively that you guys can access leverage that you didn't otherwise know was available to you. Let me just take a quick pause here. And before I go into, hold on, gang. Before I go into the refinance side of this, where is everybody? Here we go. What about questions? Or if you don't have questions, does anybody have anything that I have not mentioned yet in a way of creative financing that you have done that you'd want to share with the group? Let's share. Sharing is caring.
Well, we can start out with some questions because we do have a few.
Okay.
So Terry asks, what about seasoned funds coming from a stock sale?
Perfectly acceptable, Terry, as long as the stocks are yours or whomever is going to be on the loan. Let's say, for example, the stocks are in your wife's name, okay, and you're the only one on the loan, in which case, no, you would have to add your wife to the loan in order for those to be your source and seasoned funds. Otherwise, if they're your stocks, those are already sourced and seasoned. I can very easily show the paper trail for that.
Perfect. All right. And then we have a question here for loan underwriting. Would the money in a first lien HELOC already be considered seasoned if they were in the HELOC for 60 days or greater? Or or would the funds need to be transferred into a business personal account for greater than 60 days to be considered seasoned?
Good question. So secured lines of credit is going to be a HELOC, anything that is attached to real estate. Okay. A secured line of credit versus non-secured or unsecured is just a signature line, like a credit card is an unsecured line of credit. Okay. A HELOC, home equity line of credit, that is attached via a lien on a property, first lien, second lien, it doesn't matter. Those funds are already considered seasoned, liquid and seasoned. You do not need to pull them and deposit them and wait 60 days. You would simply grab them at closing, and that's your down payment or even your reserves, sourced and seasoned as it is, as long as you are on the property and the HELOC is in your name, or at least you're on that loan. Another thing that happens quite often and people don't realize, married couples, for example, is a common one. Let's say that you're both on title to the property, you're both on the first mortgage, but one of the spouses only is on the HELOC in second lien position. The spouse that is not on that HELOC, to use those funds might seem in theory like it would be acceptable, right? This is my property, I'm on it with my spouse, it is my spouse, etc. If you are not on that HELOC, those funds are not admissible as your source and seasoned. You either have to be on the HELOC, or in that example, you'd have to draw what you need, then deposit it into an account for seasoning purposes, 60 days of seasoning purposes. And let me add one more thing since we're talking about this. A large deposit, so let's say you're a really high wage earner, you make $20,000 a month, okay? And there was a $10,000 deposit in the accounts that you had provided for your down payment or your reserve or whatever. Or let's say it was $9,500, okay? And you make $20,000 a month. That's not going to be questioned. The only time I'm going to question a large deposit for source and season purposes is when it's over 50% of your income. So if you made $20,000 a month, I'm only going to question deposits at $10,000 or more. Anything below that, those will not be questioned. So I don't care where they came from. So there's a little bit of I guess, a hidden gem. If you guys wanted to deposit smaller amounts that are below that 50,000, enough so that it equated to the amount that you needed to show for the down payment, etc., right? And you chunked it out that way, then you're good. There isn't going to be any source and seasoning issues. If you guys have that scenario or that's not resonating with you, I would say let's not spend too much time on that. contact me personally and we'll go over your particular scenario and I'll guide you through how to do it.
We had one from earlier too about when we were talking about cash out refis. So Jag asks, isn't that the same as taking a mortgage out on a property versus a 60% cash out mortgage?
Not sure. Jags, can you unmute and say the question? I'm not sure I'm understanding.
Oh yeah, let me. Oh, you know, I don't see her in here anymore. She must have had to pop out. So we'll just have to ask her on
Okay.
email. But that's all the questions. But if anybody has anything else, pop them in the chat.
Okay, so let's go to creative financing. Carly, just interrupt me if it comes up, honey. Let's move on to refinancing and creative ways. So, refinancing, the assumption would be that you're having issues refinancing for any one of the reasons that we have described above. So everything that I've kind of talked about would still apply. One thing, though, that I would add to that for the refinance sector of this is if you know you're going to have a hard time qualifying, let's say you inherited a property, okay, and it's free and clear, but there's nothing that you're going to be able to do because either your credit is not where it needs to be, you don't have any income, or you don't have any funds for reserves or whatever it is. Okay, let's say that all those things are an issue or one of them are an issue. You know you're not going to get financing and you really want to tap into that equity. I would say to plan ahead, add the appropriate person to title. If you're going to try and do a cash out refinance on an investment property and you cannot qualify and you want to add a person that can qualify, maybe it's a family member or a spouse or a partner, business partner, whoever it is, get them on title ASAP. Depending on the product that we look at, you're going to need at least 2 months with that person on title and up to 6 months with that person on title if you're going to pull cash out and you cannot qualify yourself. If you don't do this in advance, if you don't have that forethought to add that person that can qualify, if you can't, to the title and you just decide to just do it, put him or her on title today and then go refinance the next day, not going to happen, especially if it's a cash out. If it's a rate and term refinance, then it's fine. You can add someone the same day, well, the day before you take the application or we take the application. No seasoning is going to be required in that case to refinance out of a higher interest rate loan or an adjustable rate loan or whatever it may be, whatever your circumstances are, no seasoning will be required. But if you're going to try and refinance and pull cash out, you do not qualify, but your spouse does, or your business partner does, or whoever else does, you're going to want to have to plan ahead and put that person on title at least 60 days in advance of submitting an application and up to 6 months in advance, depending on the product type. So if that's your scenario, I would say also let's not spend too much time on that. Just contact me directly and let's go over the particulars and I'll advise and tell you where we want to plant the seeds and what we want to do with that. Also on a refinance, similar to what we talked about on the purchase side, a bridge loan might be a real handy tool. Now it's going to incur probably more closing costs if you've got to get 2 loans. Let's say you got to clean something up. You need to buy yourself some time. You have to refinance for whatever reason, whether it's cash out, getting out of a hard money loan that's called due, whatever it is. And you're just not ready to do that. You might want to get another bridge loan or just a bridge loan to buy the appropriate amount of time needed to clean up credit, assets, debt to income ratio, et cetera. If that's the case for you, I want to talk to you specifically about the strategy there and what needs to happen between securing a bridge loan, 6-month or 12-month bridge loan, and making sure that we're hitting the milestones necessary so that in 12 months down the road, you are ready to get out of that and submit for permanent financing, or you're prepared to sell and do a 1031 exchange. And what does that look like, right? If we go down that rabbit hole, if you, let's say you get a bridge loan and, best efforts are made, you can't refinance. You can't refinance out of that bridge loan or that private money loan, and the balloon is due, the note is called, and you have to sell it. Okay, well, what if there's a bunch of equity in there, in that property? And if you sell it, you're either going to pay massive capital gains tax if you don't reinvest it. So no thanks. So let's just assume that you're going to go reinvest those monies, but you can't qualify. What now? in that example, I would tell you the planning of that would be you better add someone to title of that property before it sells. Okay, as long as you've added someone that has some means of qualification, whether it be, a debt service coverage ratio loan product or a Fannie Freddie product or whatever, so that the proceeds from the 1031 exchange can then be redeployed in the way that would avoid the cap gains tax. Those are some of the things. A lot of this is going to be subjective, right, to your individual needs and circumstance and qualifications. So I would say that from a creative lending or financing perspective, it's probably best to have some one-on-one conversations with me or your loan officer here, just to make sure that we're not missing some detail or there's something that you didn't know to look for that we might that could change the dynamic considerably. There could be a lot of things that are involved there, but yeah. So let's see. Do I have anything else? Yeah, I'll leave that one. I'm going to leave that one. I don't know that it's necessarily relevant. I think it takes us down into the rabbit hole that I don't think is necessary. So those are some of the details that I would share with you guys. Creative financing. I do want to really quickly ask a question. Carly, if you could get a poll ready. Here is the question. And I think I'm going to add this to one of the upcoming Live with Caeli's. As we start seeing interest rates fall, woohoo! I want to know how many of you are familiar with the math. What does it take in order to decide is now the time to execute a refinance? The cost of the refinance versus the benefit of the refinance, whether it be the savings or the reduction of interest or cash back in hand, right? All of those different variables. So how many, we've got enough people in here. This should be a good one. So how many of you in answer yes or no know what the math is in determining when is it time to refinance an investment property? So let's do, we'll just take that poll. So it's a yes or no. Who knows? Yes, you know the math that tells you when is it appropriate to refinance. And then no, you don't know the math. When is it appropriate to refinance as we start to see interest rates come back down? Because that's going to be on topic, I think, for a lot of you as rates continue to improve. All right, I think they were. I think they were. The poll's up, you guys. If you can just answer one more time in the poll, let's just take a peek at that. Yeah, I think overwhelmingly people are no. So I think that's a good topic. So Carly, if you want to just make a note, I think what we'll do is at some point here this month or next, maybe next, if January is already set, let's talk about what is the math? What do we need to be looking for and at to determine when refinance is appropriate? Thank you, my dear. Any more questions from me?
Let's see here. We do have one. Jeff asked, if I just closed on a property, how long would I need to wait to refinance with a HELOC?
Hi, Jeff. So the answer is going to be, it depends on your current loan terms. Does the current loan have a prepayment penalty? And if it does, how much? Is it going to make sense? Is it worth it to eat a prepay if it doesn't have a prepayment penalty? And we want to be using an appraised value versus the purchase price. That can also hold part of the answer. So let me ask a couple questions before I can answer specifically to your scenario. What was the property? Was the purchase price and the appraised value roughly the same number?
The purchase price was $370. The appraised value is $420.
Okay, so that's a nice chunk, right? That's a $50,000 swing, assuming you want to take advantage of the 420, right? I'm assuming you don't want to leave that equity tied up. If you want to use the appraised value, and you want to leverage the HELOC to maximize it. In that example, you're going to have to wait 12 months. Okay. If you are okay to use the 370, then you could go right away. Nothing would preclude you from doing that, unless perhaps there was a prepayment penalty that we want to look at. There's some other variables that I would want to include before I could answer specifically, but you could do it right away depending on whether or not that was to your greatest advantage.
Okay, yeah, no pre-penalties. I just know that the HELOC works better for me because I can dump money into there and I can still reuse that money right away if I need to.
Yes,
Versus if
sir.
I dump it on the mortgage, it's locked up and I can't use it. So,
Gone. Absolutely. Yeah. If you're Jeff, if you're not familiar with the all-in-one, that would be something that we should spend some time talking about. That's exactly the concept that you're describing, velocity banking or infinity banking. And you don't necessarily need the all-in-one product to do it. You can do it really technically with any HELOC. It just the other HELOCs come with some disadvantages. They're not 30 years. They don't have banking features that make it real simple and streamlined. Just deposit all in, and it's just one kind of checking savings all in one with the HELOC. That's why they call it the all in one. But yeah, man, as long as qualifications are there, they're and we can use the 370. We're not trying to use that higher value. You could do so right away as long as all the other variables fit within the product guideline matrix.
okay, sounds good.
Yeah. Send me the scenario and we'll look at it together, sir.
Yeah, actually, we have a meeting on the 5th, so we can go over it
Cool.
all then. All
Okay,
right.
perfect. Perfect. Look forward to it, Jeff. Thanks for the question, sir. What else we got, Carl's?
No other questions currently, but pop them in the chat if you have them.
Does anybody have any fun anecdotes or stories about creative financing that they've used along the way in their real estate adventure or journey? Anybody have anything fun that might be useful to other investors that you were able to employ for creative ways to secure properties? Okay. Well, then that does it for me, gang. Thank you for being here, you guys. Carly, what do we have next and when? When's the next one?
Yeah, so on, let's see here, January 16th, we're going to have a special guest speaker. His name is Sam Parker. He works
Good.
with my credit guy.
Okay, very cool. So this guy, I would say you guys definitely want to be here for this one, whether you've got perfect credit or not. I think Sam is going to be able to shed some valuable insight on how to optimize credit. I know some of the tricks that I share one-on-one in our certified power buyer um, uh, education that we provide, but he's gonna level up on that. And for those that have, maybe good credit at the 720 or 700 mark, even 680, that's a good credit score. Sam is going to come with the tips and tricks and tools that'll show you how you can increase that, which means maybe higher buying power and or better rates and terms. So that'll be a really good one. Sam is a find for sure. Very excited to have him part of our kind of associated team. Okay, that's it for me from rainy Portland, Oregon. Happy New Year, everybody. I'll see you guys in a couple of weeks. And if you need us in the meantime, Carly, take us home.
Yes, please email us at info@ridgelending.com with any questions that you have. You can also call us in our office, 855-747-4343. That's 855-747-RIDGE. Thanks, everybody.
Thanks, honey. Bye, guys. See you soon.